Hello, this is David with Everything Economics, and we're continuing with our lectures on key economic indicators. And this one is called the VIX, or the Volatility Index. So we're going to talk about the VIX index. So let's go ahead and get started. What is the VIX? Well, the VIX is also known as the fear index. You might hear that sometimes in the news or in any articles you might read. It measures the market volatility or the expectations of market volatility. If any of you have ever looked at the stock market, it's constantly fluctuating and sometimes it is a lot more volatile than at other times. Um, and I'll show you an example here in a few minutes. The VIX was introduced by the Chicago Board Options Exchange in 1993, um, and this is for trading in futures, particularly stocks, based on the implied volatility of the S&P 500 index options. So if you've ever purchased a call or put or any other type of option, uh, uh, if the fear index or the VIX index would kind of show you that where investors are heading. If there's a lot of fear, concern over the future, if they foresee a lot of economic trouble and they think the stock market's going to go down, then they're probably going to put in a lot more options. Reflects investor sentiment and market uncertainty, as I was just talking about. All right, well, why is it important? Well, the VIX plays a key role in financial markets. It's an indicator of investor fear or confidence. It helps in portfolio risk management, and it's used to price volatility-based derivatives, such as options. So when you look at the VIX, if you're investing in the market or you have stocks in the market and you see the VIX rising, that means that there's a lot of concern in the future. And so uh, there's going to be a lot more option tradings because either they're concerned that the stock market's going to drop and they don't want to lose their assets, or they don't want to lose the value of their assets, or the stock market's going to take a huge rise in the future, and so they're taking options to buy a stock at a cheap price and purchase it later or sell it later at a profit. So how to interpret the VIX? Well, this is common interpretations. So if the VIX is below 20, that implies a stable market with low volatility. That means things are kind of okay. Nothing, the investors are not fearful about the future or maybe not even exuberant about the future. There's a lot of stability right now. If the VIX is between 20 and 30, that means there's going to be moderate volatility. That means uh, investors are going to be more wary and they might try to cover uh, their stock purchases or with options to try to protect their investment. If the VIX is above 30, that means there's high uncertainty and there's huge fear in markets. All right, so as an example here, we have the VIX, and I pulled this up. You could pull it up in just about any financial website. You could probably find it in the Wall Street Journal or in the Financial Times. But this is the VIX for the past 10 years. And today, currently, when I just pulled it up, so that's today, what is it, September 30th, 2025, the VIX index was at 16.11. Okay, so that's below 20. That implies kind of a stable environment. Just a few months ago, the VIX had reached 25, which implied there was a lot of uncertainty. This kind of goes along with the tariffs, the Liberation Day tariffs, and the trade war that was initiated by the Trump administration. So there was a lot of uncertainty as how that's going to affect the market, and so you had this fear index, the VIX, increase. And of course, for the past few years, it's been kind of stable, relatively. But if we go back during the pandemic, we go to the peak of the pandemic in 2020, the fear index reached almost 55. It looks like about 54, 53. Excuse me. And so there was a huge amount of fear about the future. And so people were buying options to protect their investment, or they were, or they knew that the market was going to crash, and so they were buying calls to cash in on uh, someone else's loss, so to speak. But we had a huge fear factor, or huge VIX back in 2020. And of course, we had a few other high points in 2021, and then it kind of leveled off. And then we had inflation, concerns about inflation, higher interest rates. That was back in 2022. And so the VIX increased and got above 30. But that gives you a general idea of what the fear factor does. And if we look even further back, if we go back to like 2018, 2019, the economy is booming and there's really not much to be concerned about. No tariff war, no pandemic. And so the fear index, or the VIX index, was pretty low. All right. So what are the key takeaways? Well, the VIX is a measure of market's volatility expectation, often called the fear index. It's useful for investors, traders, and researchers, and it helps us assess risk and uncertainty. And so you can, like I said, you can go on just about any financial website and look up what the current VIX is. And that kind of gives you the state of how investors are feeling at the moment. And like I said, for today, it was like around 16.11, which is, not, it's below 20, therefore it's not bad. But anyway, that's it for today. I hope you enjoyed it, and stay tuned for more information on key economic indicators. Bye for now.